There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone. Today we're going to talk about the downside and selling short in the stock market. Most people buy stocks for either a long-term hold or as a short-term trade, and they never consider what happens when the market turns down, becomes a bear or correction, and how they manage and handle this and how they can make money even when stocks go down. A lot of people believe that selling short should be illegal, that it's wrong, that if somebody is selling short, then someone else is losing money. The problem with this ideology is that it is a very limited scope perspective of how the stock market works. There are 9 different market participant groups. There are hundreds of giant to large-sized to mid-sized buy-side institutions. There are tens of thousands of small funds, foreign funds, nonprofits, and other smaller funds that trade the market. There are 5,000 corporations that may trade the market. There are thousands of professional traders. There are tens of thousands of retail traders. There's hundreds of thousands to millions of small lot investors. There are a few dozen HFTs. And there are the big banks and financial institutions that also trade and invest in the stock market. So there is a very vast, large, and diverse group of groups that trade and invest in the stock market. I have to laugh every time I read the retail news saying, investors sold off today because they felt this. Or investors bought today because of this. It's not one group. Not everyone agrees. Not everybody is buying at the same time or selling at the same time. When the market turns down, then we have a situation where there are more people wanting to sell than people who want to buy. If there is no one to buy the stocks that others wish to sell, the stock price plummets until someone decides to buy. The Chinese tried to get rid of sell shorters because they didn't understand the stock market. The government was trying to control the stock market, and so they made selling short illegal. And their markets collapsed in huge, gigantic waves that hadn't been seen anywhere globally since the 1929 Great Depression. Selling short offers an opportunity for those who just want to sell and get out of their stocks to have someone buy the stocks. Sell shorters take short-term opportunities, intraday or daily charts, and they see the opportunity to sell short, and then they buy to cover after the stock has fallen. The stock market is obligated to provide a buyer for every seller and a seller for every buyer. So if there are more buyers, price moves up until someone wants to sell. If no one wants to buy and everyone wants to sell, the stock will drop in price until someone steps in to buy it. This is where the sell shorters help slow down the rundowns and the collapses of markets by buying periodically at technical support levels. Sell shorters do not cause bear markets. There are not enough of them. There are only 3 small market participant groups that actually sell. The number of people who sell short are very, very small. There aren't many of them. The HFTs, which there's a couple dozen of them, professional traders, a few thousand, and retail traders, again, just a few thousand actually sell short. Sometimes the banks will sell short, But the buy-side institutions do not use sell shorting usually. If they are trying to mitigate or hedge a fund that is declining in value, they will buy option puts, causing the put-call ratio to rise, which a lot of you use to sell puts, which is a big mistake because they're not planning on the market necessarily moving down. They're just using option puts as an insurance policy. Or they use futures contracts on indexes. The sell side is not the opposite of the buy side. And everybody who owns a stock or a mutual fund or a pension fund needs to understand the downside of the market. The reason we have such deep market corrections is most people have no idea what's going on in the stock market. They listen to the nightly news, which doesn't give them any viable, good information, just a lot of hype and stuff to make them emotional, because all news wants is to have their advertisers happy, and the advertisers want you to be emotionally involved. They want you to buy speculatively. And they don't care if you sell in panic because they will always make money. And I'm talking about they as retail brokers and others who provide services to the retail community. Retail is anybody who's not a professional in the market. And that is a very, very large group. Millions of people have mutual funds. Hundreds of millions of adults have 401ks or pension funds. We have a lot of retail. So when you don't know about the downside and you don't understand how the market moves down or why it moves down and when it's likely to move down, you're either going to be buying speculatively into a top or you're going to be selling in panic in a bottom. That's usually what happens. I'm sure you've heard buy low and sell high, but the majority of retail investors and retail traders buy high and sell low. Because they don't understand how the market works. They don't understand technical analysis. They think that the economy has to be booming before the stock market actually will move up. They believe that a bear market happens only after there's a great recession and everybody's laid off. The fact is the stock market moves ahead of the economy. If you follow the stock market, you will be able to figure out the economic cycle 6 months to a year before that actually happens. But that's really hard for people to understand. The reason it's not right is that the economy can't grow unless businesses have already grown. The economy can't expand until businesses have been growing for several quarters. The economy doesn't expand and then businesses get better. Businesses get better and industries grow, then the economy grows. So the stock market reflects the current value of business. It reflects the current activity and growth in individual corporations. So if the stock market starts to move out of a bear market in 2009, that's the end of that bear market. But nobody would believe that. Everybody was too afraid to buy into the lows of the bear market in March 2009 and ride the whole entire bull up. Now, if you look back on it technically, you think, oh, wow, that was a great time to buy. But you didn't because you felt that the economy was lousy. But the stock market reflected the fact that businesses were recovering and going into a recovery mode. And that's the ideal time to buy. The stock market leads the economy, not the other way around. If you learn about the stock market and you learn about its cycles and you understand the downside, you can make money selling short and not impact long-term investors. How does that happen? Just because you're making a profit in a stock doesn't mean someone else is losing money. That's a misnomer, and that's a common misperception among people who buy and sell stocks. You can have somebody who bought a stock a while ago and sells it to you, and you buy that stock. You both are making a profit. The same is true with selling short. There may be a short-term sell down, and you may sell short alongside pro traders, which is the ideal, and then buy to cover and have the stock move up a little bit after you buy to cover, because then buy on the dip investors come in. Most of the stock is held in long-term investments, and those long-term investments ride the natural and normal ups and downs of the stock market, the short-term and intermediate-term trends, as the stock market moves up over many years. The only time that those long-term investors are at risk is if we actually have a full-blown bear market and they panic and sell after the market has collapsed. As long-term investors, you need to learn about the downside market because you need to be able to make two decisions, not just one. All your mutual funds and pension funds tell you to hold. And even if there is a bear market, just hold and it will come back. Well, yeah, eventually it does. But how many years does it take? And are you in retirement and your account has dropped 50%? That's a problem. If you understand the downside of the market, then you will be able to see the peaks and the tops, and you'll be able to make a decision whether this is a risk of a bear or just an intermediate or short-term correction. If it's an intermediate or short-term correction, you want to hold. But if this is going to be a full-blown bear market, and I use 10 different data that I analyze to determine when a bear market risk is present, and I let my students know this. If a bear market is on its way, you may want to consider moving some of your investments out of stocks into other investments. Or you may accept that you're going to lose a 50 to 80% value and ride it out and wait it out for a few years. That's your prerogative, but you should make that decision knowing in advance that there's a likelihood of a bear market and there's a likelihood that you could lose 50 to 80% of your fund value or your stock value. The other aspect is you can also sell short or use option puts or use ETFs to mitigate the downside risk or the downside losses if you learn about the downside. So you have an opportunity to not only leave your investments alone, but also mitigate the downside by short-term trading the downtrend so that you make money as the market moves down, which offsets your losses in your long-term investments. You have to remember that as a retail trader or a retail investor, you are not trading on the exchanges. You're not trading against other people. The SEC did a study a few years ago of the top 5 or 6 retail brokers in the United States, the largest retail brokers. They were suspicious that the retail brokers were taking advantage of their retail customers. They wanted to ensure that the retail brokers weren't skimming and making more profits than they should against their retail traders. So what they did is they studied the retail brokers and they discovered a very shocking fact. Over 95% of all the orders that retail customers enter into their broker are never sent to the exchanges. Retail brokers now hold vast quantities of inventory of stock in street name. That means they can transfer the title back and forth at will without having to do anything. Retail brokers fill the majority of their retail customers' orders, whether you're buying, selling short, or buying to cover. So if you decide to sell short, you are not trading against some retail investor. You're not trading against anybody but your retail broker. The retail broker is providing the stock for you to trade. You borrow the stock from your retail broker. You sell short, then you buy to cover, you buy that stock, and you give the stock back to your broker. The transaction for that occurs within the brokerage company itself. So when you sell short, you are not hurting somebody else. You're selling short with your broker's inventory. How sweet is that? What you need to do is make sure that your broker doesn't rip you off. They have spreads and they have all kinds of things that they can do to make extra money. They give you a very low cost fee or no cost for trading. They may charge an interest rate because you have to use margin when you use selling short. And they have many ways of making money from their retail customers. Do you think that these really low fees that they charge for transactions actually cover the expenses of their business? No, they don't. Retail brokers make their money by using wider spreads, buying stocks at bargain prices, and then selling them to you at very, very high prices. Now, There is a way to control how your broker handles your orders. There are bracketed controlled orders that force the broker to fill the order at a specific price. And I'm not talking about limit orders. Limit orders are a wide open berth for the broker to take total advantage of you. So are at market orders. There are other types of orders that you can use. At TechniTrader, we teach a very special, unique order type that we discussed with a market maker when we first developed it, and that we have used for over 20 years, that ensures that our students' trades are not exploitable by the broker. You want to learn how to do this? Become a TechniTrader student. If you want to learn how to properly sell short with a full trading process that ensures that you have low risk with high probability of a lot of profit selling short, we are the only place to get that education. There is no other company that has a complete course on selling short. Most of what you have out there are retail traders who've come up with a bright idea. They call themselves professionals, and they're not, because they're not credentialed. They sell you their idea of a strategy. You buy into it, and you spend a lot of money learning the strategy for selling short or buying long, and then you lose a lot of money and you get frustrated. Most of the training companies out there are not professionals, even if they call themselves such. A lot of them are salesmen from other companies trying to get out on their own and have their own little company. Their training methods are $19.99, and that does not work anymore in our markets. We're the only company with a complete trading process for selling short. Now, you can play around and lose a whole bunch of money trying to learn to sell short or use a sell short strategy, or you can just sit out the market and watch your money go down the drain, or you can be smart and come to our website, check out our courses, and buy the course that is appropriate for you. We have extensive student support, mentoring, guidance, daily emails, teach you what's going on in the market. We have the best support anywhere. There is no other company that can even touch us in terms of how we support, guide, and help our students become consistently successful. And that's the name of the game. Making one great trade and then having dozens of losing trades is not consistent success. A lot of people will say you can make money if only 40 or 50% of your trades are successful. Do you think that professional traders have a 40 or 50% success rate? They have an 80 to 90% success rate. That's why they make 6 and 7 figure digit incomes. You cannot be successful if you do not know how to swing trade the buy side and swing trade the sell side. That goes for you day traders too. You have to learn both. The upside and the downside, price action, indicator action is totally different. Just because you know how to buy a stock doesn't mean that you know how to sell short the stock. Plus, you have to turn your mind around. This takes practice. You can't just suddenly switch from buying and then feel comfortable selling short. You will not feel comfortable, and you will make mistakes because your mindset is buying, not selling short. So come to our website, check out our courses, and then read one of our outlines that looks like it works for you. Then give us a call and talk to one of our curriculum advisors. You can set up an appointment where we can talk to you for a while and find out what you're doing. I want to assure you that everything you've learned thus far is useful, but what you have is gigantic holes in your education, and that's why you're not as successful as you deserve to be. You work very hard at trading stocks. You have the right to be as profitable as any professional trader. If you come to TechniTrader, you will get the education you need and become successful. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable. But like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.